the stock market is still bullish and the drop is a normal pullback. Today's main event is to appreciate why the market tanked for 6 straight sessions followed by a dramatic bounce into the close Tuesday. In reading the articles by most of the main media outlets, they want to pin it all on whiffs of inflation leading to higher bond rates. Yet positive comments from Fed Chairman Powell today put investors' nerves about inflation at ease. Bond rates could double and stocks would still be the infinitely better value. So really this is a false boogeyman. Let me give you a much simpler, and much more accurate rendition of events. This is just a classic reminder that Mr. Market does not like when investors become too complacent. Because just when the gains are coming too easy, it's time for a good old-fashioned wake-up call. Those who think that something more nefarious is happening will be thrown off the bull by selling their tumbling shares. Those are the weak hands. The reward comes to the rest of us who hold on tight knowing the green arrows are right around the corner. And for an even simpler answer, the market often needs to digest gains by having a classic 3 to 5% pullback. So after hitting 3,950, we retreated down to 3,805 today. That is a tidy minus 3.7% pullback to just above an important resistance level at 3,800. So a bounce was soon in the offing. That's really all that happened because the bullish conditions are still fully in place. Here is that quick roll call of reasons as a reminder. Low bond rates make stocks the 3x better value. Yes, 3 times better. It was 4x better until the recent rise in bond rates. Coronavirus vaccine plus major worldwide drop in cases equals investors see the light at the end of the tunnel. Overall economic conditions improving at a much faster pace than most experts predicted. That includes corporate earnings well ahead of expectations for a second straight quarter. To be clear, rates are indeed on the rise. The case for higher rates got a booster shot last week when Yellen doubled down on the call for more stimulus. Not just this round, but also a large infrastructure bill later in the year. Putting all that together, with the other facts in hand, it's not hard to appreciate how this leads to further inflation. In fact, she even said as much that the risk of not acting with stimulus is much greater than the risk of higher inflation. This has the 10-year rate all the way up to 1.36%. A big move up from 0.5% back in the summer. But still a far cry from the historical norms closer to 4%. On the economic front, we enjoyed another week of mostly positive news. Going back to last Wednesday, the retail sales report took a Herculean leap of plus 7.43% year-over-year. This corresponds with the impressive gains found in the weekly Redbook retail sales report. Then we found out that housing continues to be red hot as lower mortgage rates are leading to a housing boom. However, it's a bit late for investors to jump on that train as housing is a lagging industry based on old measures of demand. As bond rates have doubled in the past 6 months, so too have mortgage rates risen. That trend will continue for a while, making housing more expensive every basis point higher from here. The more telling economic report is Philly Fed Manufacturing Index, which, just like its cousin, Empire State, is pointing to serious strength in the sector. After the plus 23.1 reading for Philly Fed, we got more positive news from other regional manufacturing reports like plus 17.2 from the Dallas Fed and plus 1.4 from Richmond Fed. The more all-inclusive PMI flash report on Friday told a story of broad-based economic gains. Not only was manufacturing hot at 58.5, the services component was even better at 58.9. As I have shared with you guys before, anything over 55 for this report, or an ISM report, is a sign of strong economic improvements. The great curiosity at this time is whether 4,000 is still a point of major resistance. Or was this pullback the pause that refreshes, so that the market could build up strength to break above with gusto? Thank you for watching this video. We appreciate your continued support. For more daily news, please subscribe to our channel. This is Economics Empire, and we'll see you in the next one.